Okay, let's dive in. If you've felt like you're trying to keep your head above water in a whirlwind of news lately,
Yeah.
watching stock markets jump and dip based on decisions coming out of Washington, noticing shifts in the housing market, hearing about major tech breakthroughs, and maybe even wondering what happened to all the pennies, you are absolutely not alone. Welcome to a deep dive.
We've taken the stack of sources you've shared with us, and they cover quite a range, really. I mean, everything from policy debates happening in Washington
Right.
and how global markets are reacting, all the way down to shifts in consumer behavior and, what's happening at the cutting edge of AI development.
And our mission today is, well, pretty straightforward.
Mm.
We're going to cut through the noise, extract the essential nuggets of knowledge and insight from these sources, connect the dots across what might seem like unrelated headlines,
Hmm.
and help you navigate these different currents to understand what's truly important for you to be well informed about right now.
Sounds good.
So where do we start? Let's kick off with the big picture, that collision we're seeing right now between
Yep.
markets and policy. The S&P 500 closed the day pretty flat, but that number hides a lot of underlying tension and movement.
Yeah, definitely. That tension seems to be largely driven by one key factor in the bond market: rising long-dated Treasury yields. We saw the 30-year Treasury yield hit its highest level since, October last year,
Yep.
even briefly climbing above 5.16% today.
Okay, so why should we care about that number? I mean, why are those long-term yields ticking up like that?
Well, a significant factor, according to your sources, is growing investor concern about the expanding U.S. deficit.
Okay.
And that concern has been amplified lately by a major House bill that just passed, which some investors fear could make the fiscal situation even more challenging.
I saw that Ray Dalio quote in the sources. He's pretty direct about this, right? Warning investors to fear the bond market specifically because of soaring debt.
Exactly. Dalio calls the situation critical over the next 3 years, pointing out that the current deficit is around 6.5% of GDP. Right.
Which he believes is more than the market can bear. It's also worth noting that Moody's cited fiscal concerns linked to deficits when they issued a credit downgrade for the U.S. just last week.
Okay, and how does that translate to the real economy, to, someone listening right now?
Well, higher long-term Treasury rates serve as a benchmark for a lot of consumer loans, mortgages, car loans, business borrowing.
Right.
So when they rise, it adds pressure across the board, impacting borrowing costs for individuals and companies. And this comes on top of the existing pressure from current universal tariffs.
And this isn't just a U.S. thing impacting yields. Is it hitting elsewhere?
No, your sources show European markets also closed lower today, reacting to the rise in long-dated U.S. treasuries and those concerns about U.S. fiscal spending. Some analysts, like those at UBS, are seeing clear momentum diversifying away from the U.S. dollar right now,
Interesting.
linking it partly to these dynamics.
So what's the overall market sentiment picking up on? What are analysts saying? Well, Citi analysts are looking ahead and expecting economic growth to weaken in the second half of 2025. Part of their reasoning is that consumers and firms might be sort of front-loading spending now.
Ahead of tariffs.
Exactly, to get ahead of anticipated tariffs, creating what they call a calm before the storm. And Wolf Research echoes the point that long-term rates are expected to remain major drivers for market movements.
Okay.
And that brings us directly to this major piece of policy we mentioned, the One Big Beautiful Bill Act that just narrowly passed the House.
It was close, right? 215 to 214, I think,
That's it.
with every Democrat voting no.
Yeah.
And Republicans are framing this as a big win. They want to get to the president's desk by July 4th.
Yes, a significant political moment, definitely.
Yeah.
And the bill itself is massive, a multi-trillion-dollar package that aims to extend the 2017 tax cuts, make substantial changes to federal student loans, and include major cuts to social safety net programs, among other things.
The political maneuvering sounds intense, too. Sources mention last-minute amendments and a, 21-hour Rules Committee session just to get Republican factions on board.
Yeah, quite the process.
But you said Wall Street's reaction was less enthusiastic?
Right. Despite the political win for Republicans, the market reaction we discussed earlier, focusing on deficit worries, shows that investors are looking pretty hard at the fiscal implications.
And the analysis of the bill seems pretty polarized based on the sources. Really different takes.
Absolutely. The Republican view presented in your sources is that this is vital to kickstart our economy, provide certainty in the marketplace, and deliver on promises like increasing the SALT cap. They see it as a major achievement.
Whereas the Democratic and analyst perspective focuses on different impacts.
Correct. Democrats, according to the sources, vehemently opposed the cuts to safety net programs. A CBO analysis estimates that, if enacted, the bill would generally decrease resources for the lowest income group while increasing them for the highest. And many analysts are raising concerns about exploding federal deficits and weaker long-term fiscal health. Your sources make a point of presenting these views without taking a side, just showing the different ways the bill's impact is being interpreted.
Got it. Okay, so it passed the House. What's the path forward? What happens next?
It moves to the Senate, where it can advance using budget reconciliation, meaning it only needs a simple majority. However, sources note that several Republican senators have already indicated they require significant changes to the bill before they'll support it.
Ah, so it's not a done deal in its current form.
Not by a long shot, it seems.
All right, let's zoom in then. Assuming some version of this bill, or maybe just these types of changes, were to happen, what could that mean more directly for your personal finances? The listener's wallet.
Right. This is where the rubber meets the road for many people. The bill touches on a lot of different areas of household finance.
Let's start with something that affects homeowners in higher tax states, the SALT deduction. What's happening there?
Right. The state and local tax deduction cap, currently $10,000, would be raised to $40,000 in 2025 under this bill.
Okay.
There's an income phase-out starting at $500,000 adjusted gross income, and then annual increases to the cap from 2026 through 2033. The key takeaway here, really, is that this change primarily benefits higher earners living in areas with high state and local taxes.
Gotcha. What about the child tax credit? That's a big one for families.
It is. The bill proposes making the current $2,000 credit permanent and increasing it to $2,500 for a few years, from 2025 to 2028.
Okay, a temporary boost.
Right. After that, it would revert to $2,000 and be indexed for inflation. However, critics highlighted in your sources point out that this change does nothing for the 17 million children in very low-income families who don't have a federal tax liability and therefore can't claim the full amount.
Right, the refundability aspect. Okay, shifting from taxes to spending programs, there are significant proposed cuts here, according to the sources.
Yes, the bill includes roughly $1 trillion in cuts to Medicaid and SNAP, described by one analysis as the largest in their history.
$1 trillion. Wow.
Yeah. The impact of changes like stricter work requirements could, according to one analysis cited, mean 14 million individuals losing health coverage.
14 million.
And 3 million households losing food assistance. Again, just reporting the analysis impartially as presented in the source material.
Understood. What about seniors? Is there anything specific for them?
There's a provision creating a new $4,000 tax deduction for seniors' income. This is presented as an alternative to eliminating Social Security taxes entirely.
Okay. How does it stack up?
Well, based on estimates, this specific deduction saves the average senior taxpayer significantly less annually, around $480, compared to an estimated $1,440 if Social Security taxes were eliminated. So, quite a difference.
Right. Health savings accounts, or HSAs, see some changes too.
They do. Starting in 2026, the bill proposes expanding them. It would double the annual contribution limits for lower and middle earners, those making under $75,000 as individuals, or $150,000 as couples, up to $8,600 and $17,100 respectively, using the 2025 limit numbers.
That's quite a jump.
It is. Plus, it would allow using HSA funds for sports and fitness expenses, with caps of $500 for individuals and $1,000 for couples.
Interesting. There's also something in here about new savings accounts for kids. Trump accounts.
Yes, they're being referred to as Trump accounts. The idea is a new savings vehicle for children starting with a one-time $1,000 federal deposit.
Okay, a starter fund.
Exactly. Parents could add up to $5,000 a year with the money invested in a U.S. stock index fund growing tax-deferred. Qualified withdrawals would be taxed at the lower long-term capital gains rate and could be used for education, buying a first home, or starting a small business.
Okay. Now, for anyone with or considering student loans, the proposed changes look pretty significant and maybe not necessarily in the student's favor.
That's a key takeaway from the sources, yeah. The bill would reduce benefits by eliminating subsidized federal loans.
Oh, wow.
Meaning the government would no longer cover the interest that accrues while you're in school or deferment. One expert estimates this could increase a student's loan balance at graduation by about 15%.
15% just from that.
That's the estimate. New income-driven repayment plans could stretch forgiveness out to 30 years, compared to the current 20 or 25.
30 years?
Yeah, I saw one expert quote calling a 30-year term indentured servitude. It also removed options for unemployment and economic hardship deferments.
Wow, okay, that's a major shift. What about car loans? There's a new deduction mentioned.
There is, but with a big caveat. From 2025 through 2028, you could deduct up to $10,000 in annual interest on an auto loan, but only if the vehicle was assembled in the U.S.
The Made in America angle.
Exactly. It's an above-the-line deduction, so you don't have to itemize, but it phases out based on income, starting at $100,000 for individuals and $200,000 for married couples modified adjusted gross income.
Got it. And for people who earn tips, service industry folks.
Qualified tips would be exempt from income tax through 2028, but limited to those earning less than $160,000 in 2025.
Okay.
It's interesting context that the Senate recently passed a similar bill, but with a much lower $25,000 limit on the tip exemption. So a big difference there, too.
Right. Finally, clean energy credits seem to be on the chopping block. EV credits, home efficiency.
Yes, the bill proposes ending tax breaks for buying or leasing electric vehicles, the $7,500 for new EVs, $4,000 for used, and credits for home energy efficiency projects after 2025.
Sooner than expected.
That's about 7 years earlier than planned under current law. Yeah.
Oh, okay. Moving from policy details, let's look at how different industries are responding to the current environment, pulling out some specific examples from your sources.
Sure.
One area that saw a huge impact today was the solar sector. Why the big plunge there? What happened?
That was a direct reaction to the House tax bill we just discussed,
Yeah.
specifically its proposed termination of key clean energy credits.
Connecting the dots.
Exactly. Companies relying on residential solar leasing models like Sunrun were hit particularly hard, seeing their stock drop 37%.
37%. Ouch.
Yeah, linked to the end of those lease credits. Inverter makers like Enphase and SolarEdge also sank significantly, down over 19% and 24% respectively, as the changes point to decreased demand for rooftop solar installations.
So the market sees that part of the bill as a sledgehammer to the industry, as one analyst put it. That seems strong.
That was the term used describing it as worse than feared by analysts, precisely because it targets the residential leasing model and production investment credits that have been driving growth.
Got it.
It's noteworthy that First Solar, which benefits more from a manufacturing tax credit that was largely untouched in the bill, was relatively less impacted, though still down over 4%.
Okay. Looking at retail, we saw a contrast today, didn't we?
Definitely. While Target has been struggling lately, Urban Outfitters saw its stock soar 18% today after reporting a strong earnings beat.
Nice jump for them.
And Advance Auto Parts had a record-breaking one-day stock gain after beating earnings and sticking to their forecast, highlighting their ability to manage costs and sourcing despite tariffs, kind of bucking the trend there.
Right. Let's circle back to the housing market we touched on earlier. The sources show a slowdown continuing there, right? Sales dipping.
They do. Home sales fell in April to a 7-month low, the slowest April since 2009, actually.
Wow, since '09.
Yeah. Sales are still only about 75% of pre-pandemic levels. Adding to the pressure, mortgage rates ticked up today, with the 30-year fixed rate hitting 6.86%, the highest since mid-February.
And in that environment, are buyers finally getting a bit more leverage? Maybe some wiggle room?
In some markets, yes. Your sources point to buyers increasingly asking for concessions like price reductions or help with closing costs.
Okay.
And a fascinating detail is the rise of all-cash purchases in certain states, like over 41% in West Virginia, 40% in New York, and nearly 39% in Delaware.
A huge percentage. Why the cash surge?
Well, that surge in cash offers helps buyers stand out in a slower, more competitive market, especially when financing is getting pricier.
Makes sense. What about some interesting new ventures popping up? Any startups catching attention?
There are a couple worth noting from the sources. In healthcare, the founders of Amazon-owned PillPack just launched General Medicine.
Oh, interesting pedigree. What's the idea?
It's pitched as an online marketplace designed to tackle the terrible experience of American healthcare, connecting users with providers based on specific needs, accepting cash and insurance, and leveraging various existing provider networks, trying to streamline things.
Okay, one to watch. And in digital health, we saw an IPO breakthrough. That's been quiet lately.
Yes, Hinge Health. Their stock saw a 17% pop in their NYSE debut today, raising $273 million.
Solid debut.
Yeah, this is seen as a pretty significant event for the digital health sector after a quieter few years, highlighting their focus on automating care delivery for chronic pain and rehab.
Got it. Switching over to tech and AI, Intuit had good earnings post-tax season.
They did, with a strong Q3 earnings beat and good guidance. And they highlighted their investment in AI as being driven by customer demand, which is, a theme across many companies right now.
Definitely. Speaking of AI, Anthropic launched Claude 4. What's notable about that release?
Your sources highlighted their claim that the Opus 4 model is the best coding model available. They're really focusing on tackling complex tasks and building agentic behavior.
Agentic behavior, meaning,
Meaning models that can take actions and make decisions to achieve a goal while acknowledging the risks of these systems potentially going off the rails, as they put it.
right, the safety aspect.
Exactly. They're also seeing rapid growth, now at a $2 billion annualized revenue run rate, and recently secured a significant $2.5 billion credit line. So, big money flowing there.
Wow. Any potential headwinds in the AI space mentioned? Clouds on the horizon?
Yes, Marvell Technology, which makes chips, saw a downgrade. The concern there is that while their current AI business is strong, analysts worry their core optics technology, crucial for AI chips, might become less relevant by 2030.
Looking further out.
Yeah, it's a look ahead at potential shifts in the underlying tech. Competition moves fast.
And a quick note on Sakana AI in Japan.
That source pointed out Japan's potential to build its own AI infrastructure, possibly leveraging talent arbitrage, and even joked about being a top tourist destination as a factor in attracting global talent. A bit of a different angle.
Okay. Finally, a surprising note, perhaps, from the online dating world, the CEO of Tinder stepping down.
Yeah, it was noted in the context of broader challenges. The online dating industry seems to be facing inflation impacting user spending, a perceived lack of innovation, and maybe some market stagnation.
Interesting times there, too.
Okay, and for our final detail from your sources, something a little different but still fiscally relevant, the end of the penny.
Wait, the Treasury is halting penny production. Like, for real, no more pennies.
That's what the sources indicate. The Treasury is ordering its last batch of blanks. Seems like the end of the line.
Why now? Is it just because they cost more than they're worth? I've heard that for years.
Exactly. That's really the primary driver. It costs 3.69 cents to make 1 penny right now.
Whoa.
That cost is up 20% just this year alone, making it nearly 4 times its face value.
That seems wildly unsustainable. What kind of savings are they expecting from this? Is it significant?
The move is expected to save $85 million annually. About $56 million comes directly from material costs, mostly zinc these days, and the rest from facility usage and efficiency gains.
Okay, 85 million isn't nothing, but
Right. While it's a modest sum compared to trillions in government spending, it's highlighted as a clear, tangible step toward fiscal belt-tightening.
it feels a bit like the end of an era, though. Any interesting historical context on the penny mentioned?
A couple of points from the sources. Pennies have been mostly zinc since 1982, shifting from mostly copper due to rising costs even back then.
So this isn't new?
Not entirely. As recently as 2021, over half of all U.S. coin production was pennies. And of course, many other nations have already phased out their lowest value coins.
True.
Your sources note this move in the U.S. has seen some bipartisan support, though the Treasury Secretary does have the inherent power to halt production. There's still about 114 billion pennies floating around, but yeah, they're significantly underutilized.
114 billion. Wow. Okay, that was quite a deep dive through the sources you shared with us today. We really covered some ground.
We did.
We navigated from the high-level tensions in bond markets tied to policy, got into the very specific details of a massive proposed tax bill and how it could impact your personal finances. Looked at some dramatic shifts happening across different industries, like solar, retail, and housing, touched on exciting new ventures in healthcare and AI, and even covered the quiet retirement of the humble penny.
What stands out when you pull all these threads together is just how interconnected everything is, isn't it? Even when it seems disparate at first glance.
Totally.
A debate in Washington over a tax credit has immediate and significant impacts on specific companies and entire industries. Market sentiment is closely watching government spending. And technological innovation, like in AI, continues to reshape business and consumer behavior at a rapid pace.
Our goal, as always, was to give you the key pieces of this complex puzzle, pulled directly from your sources so you can feel well-informed about what's happening right now.
And here's something to keep mulling over, maybe. As you look at the policy choices being fiercely debated in Washington right now, the innovations happening in AI and healthcare, and the evolving habits of consumers, whether it's how Gen Z approaches spending or the dynamics driving all-cash real estate offers,
Right.
which of these forces do you think will ultimately have the biggest, longest lasting impact on the economic landscape we live in over the next decade. Something to think about.